so we got a special guest. I think I've gotten a lot of conversations or questions as I've gone around to the different offices about the mortgage space, but not just the mortgage space. Like, yeah, interest rates went up. Shocker. They do what they do. They'll probably come down again. They do what they do. It's kind of our market. So rather than sort of that kind of conversation, I've gotten a lot of, hey, well, what do we do with the information? Like, how should we be having conversations with with sellers, with buyers, and how do we weave this into our negotiation strategy to help whoever it is that we're representing get the absolute best deal for them? And so I reached out to our friends at Point Mortgage, and they offered up Russ. I thought, well, hey, this is great. This is Russ. And then I started reading about Russ, and I'm like, oh shit, Russ is the real deal, y'all. So I'm not sure how he's been in the business for over 30 years because he looks like he's 25, but we'll deal with that one in here in a second. But this is a guy, he's been featured in all of the news channels, the nightly news, CNN, Mortgage Business, Rob Report. Like this is a guy who is the go-to source for anybody that's trying to get to the bottom of what's happening or what's going to happen in the mortgage industry. So I'm not going to spend a lot of time talking about Russ. Let him kind of do the talking. But here's what I would ask. You got this guy. This is an incredibly knowledgeable and experienced gentleman in the space. Please fill the chat box with whatever specific questions you're looking for. I know he's going to hit some of the stuff that I've been getting a lot from you all. The primary one being, hey, what's the story with buy downs? But I'm sure you all are getting a ton of questions. So this is your time. So Russ, take it away.
Todd, what an introduction, man. That, by the way, that stuff that you mentioned on CNN and all that, yeah, that's just fluff. Just fluff. Hey guys, thank you so much for having me here. Point Mortgage, by the way, we're licensed in all the states you guys are licensed in, so maybe we can get a relationship going. I run sales for Point. What I really wanted to talk about, and we have kind of a cousin relationship, right? So Point Mortgage owns a company called Coldwell Banker West. It's in San Diego, California. We have about 1,000 agents, and I'm sure that our agents are facing the exact same thing that you guys have been facing, right? Which is, wow, rates went up. My sellers have some unrealistic expectations possibly on what they think the values of their properties are. Maybe it's coming down to earth a little bit, but I mean, I'm sure your market was like ours. You get a listing, it's selling within a week at 10% above list price, crazy stuff like that. Buyers have stuck in their head 3-4% interest rates. Guys, they're higher than that right now. And as Todd said, hey, recession hits something like that, rates come down, they go up, they move every single day. But how do we bridge that gap? And one of the things that we noticed is during COVID, because the market was so odd, meaning pure seller's market, you get a listing, it sells, we kind of forgot our negotiation skills. We forgot how to negotiate because you really couldn't. You didn't have the ability to do it. Now we can a little bit. And what that means is, I ran an example this morning. I'm going to show you really quick. I have 4 teenage boys. They hate first period math. You guys are getting first period math this morning. Sorry about that. Can I share my screen real quick?
Of course.
Yeah. So quick education in mortgage, right? You guys hear, oh, what are the rates today? They're at 5.25 at 0 points. What does that mean? And how do we come up with those rates and all this crazy stuff? I'm going to give you a really fast education. What I'm showing you here, I just priced a loan yesterday, actually. And this shows you a rate ladder. And is this visible? I mean, can you guys see this? But this is a rate ladder. And how rates work is they're typically quoted in 8% increments. And you can see in this rate ladder, did you guys know I could still get a 3.875 rate? I can. I've got to pay a boatload of points to get it, but it's there. And I can get a 6.625 rate. And what happens is when we do a loan, we pool all these loans together and we sell them on the secondary market 30 to 45, 60 days after the loan closes. So we do this, and just imagine that. I'm giving you a price today on something I can't sell. I'm not sure where the market's going to be 60, 90 days from there, because you have a 30-day escrow, plus I have 30 to 60 days to sell it. So there's some hedging that goes on there. So when you look at a rate ladder, Anything north of 100 is money to the client. Anything south of 100 is money they have to pay to get that rate. Okay. So if we look here, 5 1/4 at 100.068 means that this client would get 0.068 in credit, a 0-point loan effectively. Okay, it's a 0-point loan. If that same client wanted 5%, it would be 99.473. You subtract that from 100, it's a little over a 0.5 point to get that rate, 5%. That's how a rate ladder works. So you can see each interest rate has a different cost to it because it's being hedged out. On top of this, this is one loan program, one borrower scenario. There are thousands of investors we have, but that's the reason why I'm showing you this is that when a client buys a house, what is it that they're paying for? Is it the sales price of the house? Or is it the cost of that house over its term? And most people use a loan, right? So there's a reason why when you go to a car dealership, what do they get you off? They get you off the cost of the car and they're immediately switching you to monthly payments because that's what matters to you. Same with a home loan. If I were to buy a $500,000 home and it's 5 1/4% interest rate, which was the 0-point rate I just showed you, that would put my payment at $2,761. $500,000 home, 5 1/4 rate, $2,761. Borrower, that's the payment they want. That's what it's costing them every month to be in that home. What if this, you stumble across a house, you find a house, you've done all your work, borrower loves the house, list price is $550. You go in at $500 because that borrower wants their payment to be below $2,775. That's their budget. Maybe that's all they can qualify for, right? They're reaching the edge. $550, you go in at $500. You guys are negotiating back and forth. You just can't make it work. The seller is stuck. Seller's stuck. They need $525 to clear what it is that they want to clear. So you have this gap of $25,000. How do you bridge that gap? Borrower stuck, seller stuck. Well, remember the rate ladder and remember that, all right, if the borrower's stuck at the 2,775 number, how can I get them in this house at 525? When I do the math, it doesn't work. But what I could do is I could offer more for the house than 525 and have the seller credit me money back, which I use to drive down the interest rate. There's this wonderful thing about home ownership in the US and in mortgages, and that's leverage. And when we leverage something like this, it's really quite fascinating. So I ran a little slide and I'll show you this example. Get this over here, share my screen again. By the way, guys, you don't have open forum, it's chat. Nobody can just jump in, right, Todd?
Yeah.
Yeah, okay. So chat away if you guys have questions. There we go. So in this particular example, right, this is the one I was just talking about. List price is $550, buyer stuck at $500 with this payment, seller stuck at $525. How do I bridge that gap? Well, if I said, okay, and guys, this is provided you believe the property is going to be able to appraise, because if it doesn't appraise, this kind of goes out the window a little bit. But let's say you thought it would appraise, no problem, 540, I think we can get that. Let's go 540 and have the seller give a $15,000 credit to the buyer. What does that do? Seller still gets their 525 number, right? They're going to net the same. 540 less 15,000 is 525. And I'm going to, let's go back to our rate ladder. Where's my rate ladder? Right here. And I'm going to buy this rate all the way down, let's call it to 4.5 or 4.375. At 4.5, the borrower would be paying approximately 2.3 points. Do you see that? 4.5, 97.7 minus 100. By the way, I do math all day long. I told you first period math, no fun.
There you go.
Doing the math for you. So they'd be paying about 2.3 points. Is that right? Yep. At 4.3, it's 2.8. At 4.5, it's 2.3. So let's go back to our example here. There it is. So we take that 15,000. Let's buy down that rate to 4.5. That costs $12,420. At a 540 loan amount, at 4.5, the payment is $2,736. It's substantially, right? It's a couple cheeseburgers, but it is less than the payment that the client was originally looking to get into. I still have an additional $2,580 that I can use for other closing costs. Seller gets what they want, buyer gets what they want. Big bonus. This is the bonus. So when interest rates were 2%, did you get much of a tax deduction? No, you weren't paying any interest. If interest is 0, you get no tax deduction. When you're paying interest, you start getting tax deduction. IRS allows you, if you're going to itemize on a purchase, to deduct the points you pay in the year that you purchased, right? So this particular client is going to get, sorry, I live near a train. This particular client is going to get a deduction of $12,420 on their tax return in this year. Even though the seller credited it to them, it's itemized to the buyer. So I don't know, if you're in a 33% tax bracket, that's an additional savings of $4,000 and some change. So that's kind of the ideas around this. Here's what's really important is that you have to be partnered with a lender that can kind of do this with your buyer. And more importantly, you can't just send an offer in like this. You have to get on the phone. A Zoom would be a great idea and walk through what it is you're trying to do with the listing agent for the seller. We know that, this is in the middle of a negotiation. It's possible to do on your initial offer, but the first thing to do is start getting a conversation going, right? And do you guys do value range marketing there? You know what it is? It's kind of big out here where they market a home in a range, right? I don't know. I'm listing it between 500 and 550 to start conversation. And then you kind of meet in the middle and you start negotiating. If didn't have it for the last few years, it's starting to come back now, but it's the same type thing, right? You write an offer, you start the conversation, and the art of a negotiation is to make sure that whomever you're up against is getting a win, which in this case they did. So there you go. High level, real quick, buy down. There's also things like 2-1 buy downs and stuff like that, but this is what we're getting a lot of traction on, and it's really, really working.
And is it just because the folks that are so super price sensitive, whether it be factual or sort of manufactured, right? Mentally, oh, I can only buy a house if I'm at 4%. Is it a marketing strategy or is it really having some significant impact? As you did that little worksheet, like 0.75% didn't have that big of a difference in the payment.
Well, but you're also borrowing a lot more money. You're borrowing $40,000 more. So there's that offset, right? You're borrowing almost 9% more.
Mm-hmm.
So, when we're showing people houses, what they ask is, what's the price? What can I get the home for? They don't ask, what's my payment going to be in this one? Because that's just not how that's not how homes are listed for sale. They're listed by a sales price. But the reality is, when someone buys a home, if they're getting a mortgage, it's not what they're paying for the house. That's definitely a factor of it, but it's also the loan they're getting, because they may come out of pocket $50,000 to buy the house, but every month for the next 30 years, they're making this payment. And that's what it's about, right? Mm-hmm. So if someone's getting a loan, you really have to start looking at payment, because there's ways to structure loans that get them in the home with the payment that they need.
Right.
And it could be affordability, and it could be mental. It could be, look, I'm just
all right. So from a seller's perspective, so I'm a listing agent. I go to a listing appointment. I've got a relationship with Russ at Point Mortgage. I've got this plan where, hey, listen, everybody else are selling their home at 5.5%, but I have a plan where we're going to sell your home at 4.5%, and because of that, we're going to get more eyeballs, right? Is that's what we're saying?
So and I've seen some agents do this. So what they do is they go, okay, here's my sales price when they're doing their worksheets with the seller up front. All right, here's what we're going to list for. Here's what we know you need to net, right? If I can get you to net this, you're going to sell the house, right? Yes. Okay. So what if we restructure this a little bit and we accept an offer a little bit higher than what your minimum is, but when we list it, we say we're going to give 2 points credit to buy down interest rate, which in today's market is about this, right? Then the important thing also is whoever that buyer is that's coming in is actually got a good enough lender that they're doing the math around it, or is the listing agent you offer. And by the way, this lender will show you what the numbers look like. You use whoever you want to use, but they'll explain it to you and how that helps you. So you could list that way. There's an agent in San Diego, Jerry Soto. Every one of his listings right now, we're going to give 2 points. Kind of like a new home builders, right? You go up against a new home builder and they're all, we're going to pay, we're going to get you a rate that's 1% lower by crediting you $8,000 or something.
Yeah, so that was my follow-up then. So let's talk about the buyer side. Oh, hold on one second. I got Linda told about a mortgage by a lender, marry the property, date the rate. I love that. And you have the ability 2 years to divorce the rate and to remarry the property only if you get their mortgage through them. What are your thoughts about that?
So look, if you're going to buy a piece of real estate, you're buying it. One, it's providing shelter. That's an important one, right? You're buying shelter, but it's also the greatest builder of wealth in America. Just a fact. 2/3 of the wealth in America is through real estate. Did you know that? 2/3. So if you look at I'm sure you guys know that. You guys are in real estate, right? But if owning a home is the greatest builder of wealth in America, then you should own a home and you should love the home that you're in and you should leverage that. And what the mortgage lender is telling you is that, yeah, rates go up and rates go down. There is never a guarantee that rates will go down. There just isn't. We all know that a recession is coming. Did you know that? We've had 32 recessions since they started reporting them. I did a history lesson, just like this, math lesson, first period math. I did a first period history on recessions. They come, guys. We've had a boatload of them. We actually had one in 2020. We didn't really notice it because it was at the beginning of COVID, but we had one. It simply means by the National Economic Council, after they see 2 quarters of negative GDP, that's a recession, right? Doesn't mean that housing values go down. Because if you look at it over time, there's only one time housing values have gone down in a recession, and that was that nasty financial crisis that unfortunately a lot of buyers, right? Exactly. But a lot of buyers and sellers, that's what's ingrained in their mind. So we have to educate, right? So, one of the things that I do is I've got all kinds of graphs and all that stuff that show that, look, housing is historically recession proof. It actually goes up in recessions. It's a great hedge against inflation, but you do not know how low rates will go. The strange thing that happened during COVID is we got rates before we'd say, oh, historically low rates in the 4s because normally they're in the 8s. We had rates. I actually had 10 clients that got rates in the 1s. We call them every 6 months and go, can you believe you've got a rate in a 1? But what was happening there is that the Fed, up until 4 months ago, was buying mortgage-backed securities hand over fist. That's the only reason, because nobody would buy them. And if you think about it, who's going to buy a 30-year investment that's yielding 3% when inflation right now is at 9%? I'm losing, right? Dramatically. So the Fed has stopped buying mortgage-backed securities. Unless they go back in and buy mortgage-backed securities, you're never going to see a 2% and 3% rate.
No. And that's just a form of subsidy, right? Because there's no reason to do that. All right. So questions, y'all. Let's get Russ some questions. So we've talked about on the listing side. So if I'm representing a buyer, how can I use sort of the buy down strategy to help the seller get what the seller wants, but the buyer get what the buyer wants?
Well, so the open-ended question on that you have to find out in any negotiation is, what does that seller want? Right? You got to figure that out. And that's by having open conversations. Look, a listing agent, you can't just call them up and go, well, you could, but I don't know if they'll give you the answer. Hey, what will the seller really take on this? You don't know till you guys start negotiating a little bit and dancing. I think you guys are way more skilled at negotiation like that than I am, but that's what I believe happens. So you're dancing, you're figuring it out. Okay, how do we get this to be a win? Going in, you buyer and buyer's agent, selling agent can try to figure out, okay, here's where we know we want to be, right? Mr. Buyer, will buy this house if I can get in it for this. Okay. Well, let's start a little lower than that and let's see what we can dance around. Maybe we'll get under it. So it's negotiation.
It's interesting. I'm sitting here thinking about new construction and the impact, right? So if I'm a developer and I've got 100 homes that are out of the ground, and maybe I've sold some of them at $200 a foot, $250 a foot, and I don't want to go below that, because if I do that, then I'm basically devaluing the properties that other people have purchased, or I'm devaluing my future sales, that kind of stuff. And so I'm stuck a little bit, right? So
what they're doing is this is what I'm seeing happen in certain areas in California is, okay, the market softened, right? The builder absolutely can't go in there and sell this round of houses for less than he sold the other ones. He's going to get strung up if he does. So what he's doing is, all right, let me get these sold at the same sales price or maybe a little bit higher by doing just this. How do I sweeten it? Do I put a pool in for them? Maybe, right? Or do I give them a credit on their loan and buy their loan way down? So that's what they're doing. Perfect. Flooring, right, all those things.
Do you do cost of waiting analysis? A couple of weeks ago, a lender did one on a $400,000 home. The cost of waiting 1 year was $56,000.
Yes, absolutely. And we have a bunch of different tools to do this, and they're customized for each borrower. But here's what's happening. I don't know about I know you're in 3 states, right? So every state might be a little bit different, but everywhere I'm looking, are rents going up or staying low? Staying flat or going down? They're going up, and they're going up like crazy because we have an inventory shortage in the United States. It's just a fact. We don't have enough houses. So rents are going to continue to go up. If you get a 30-year fixed mortgage, how often does your payment change? It doesn't. So one of the things with the cost of waiting, especially with a renter, is one, you have rents go up over time. Mortgages stay flat. So you have this crisscross that's going to happen potentially. Like if they're paying more for their home per month than they are for their rent, that's going to be that way for maybe a little while, but then it switches. So there's a cost of waiting there. Secondly, you have appreciation, right? And one of the things of appreciation, if my house goes up, easy math, 10% a year, and it's a $100,000 house, does that mean it goes up $10,000 every month? No. There's this miracle. It's called I think Ben Franklin called it the 8th wonder of the world, compounding, right? So do you guys know what the power of 7.2 is? What is
double?
Double, right? If you get a 10% return, your investment will double every 7.2 years, or inversely, if I get a 7.2% return, my investment will double every 10 years, right? It's a financial planning rule that they use. So let's think about this. Let's take $10,000 and I'm going to put it in the stock market. Todd, what's a great return in the stock market?
Today, losing
just
less than
historically,
15%.
What's a good return? What do people like?
So what is it? 10%, 8%?
Let's say it's 10%. 10%, that's awesome. So 10%, right? What happens in a year with my $10,000? How much did I make?
I made $1,000.
That's right. Welcome to first period math. I'm a star student today. I take that $10,000, I buy a $100,000 home. It goes up 2%. Not 10, not 5, 2%. How much did I gain in a year?
$2,000.
That's just simple cost of waiting and appreciation, guys.
Yeah,
it is
right. And never mind leverage and all
leverage
of that
is
stuff,
huge.
right?
I mean, leverage is huge. And what I always tell you guys will have clients that I had one of my wife's friends. She's buying a home in North Carolina. She's all, yeah, I'm going to pay all cash for it. I'm all, why? Well, because I can, and I want to have a zero mortgage. And then I started explaining leverage, and I started explaining your loss of taking that money out of whatever else you have it invested in. I mean, you can get an I bond right now that's giving you 9% return. Why would you take $10,000 and not put it into that, right, in finance? So yeah, short answer, yes, we have some really excellent tools. I think what's really important with those is you sit with an individual client and you talk about it, right? And you put together that cost of waiting analysis, because it changes for every single buyer. Because you need to know what, as a mortgage lender, we really need to be advisors, and you guys need to be advisors as well. So we're advising them on their future. Where do you want to be? How do you want to get there? When do you want to retire?
It is interesting, and I know our agents are probably better than most, right? At least the data would say. But it is interesting how in our industry, real estate professionals typically avoid real conversations about mortgage, when this is really an area where all of you could really differentiate yourself from the pack by just simply sitting with a guy like Russ and doing some first period math and just doing it over and over and over, so that you really understand how you can utilize some of these strategies. I know, I'm just looking at Linda Virgin here, but I know there's several of you in Twin Falls, as an example, who are working with builders and developers. What a great way to differentiate yourself and help achieve what the seller, in this case, really needs. Yes, he or she needs to sell homes. However, he or she needs to sell homes at or above the last sales price. To Russ's point, he's going to get lynched, and worse, he's impacting his future sales. What he's doing is he's indicating that that he might be in distress, right? So being able to put different kinds of accommodations that aren't maybe a pool necessarily, maybe it's buying down the rate, because we talk about how people are buying payments, not necessarily cash prices, right? That's the leverage, that's the return on cash, not return on the whole value. All of this stuff goes together, and if you can speak to it, you can really have an impact on helping both sellers and buyers get what they want, where we haven't really had to do that for a couple of years.
We forgot how. I mean, by the way, no different than all my sales crew, right? They're all mortgage loan officers. They forgot what they were doing too, because loans were falling from the sky on them. Refi. So, back to the basics. We have to re-educate, or remember what, I don't remember first period math from high school. So I have to re-educate myself on it. I will say one other thing. Look, if we're going to be advisors, you guys don't want your clients doing anything with their real estate without calling you, right? Nothing. And we know that people have life-changing events. If I take 100 people that I know well, I guarantee you 10 of them had a life-changing event in the last 12 months, right? So you have to be top of mind with them, which means you need to contact them. And I'm not just talking email drip databases going out. You need to have conversations with them, pick up the phone, do a checkup. If you guys are looking for content to talk to them about, this is some great stuff, not necessarily buying down of interest rates, but what's happening in the market, what's happening with recessions, finance type items. And look, if they have a life-changing event, they may not buy or sell their real estate, but they may need to refi it or something like that, or do debt consolidation. That's another point that I'll bring up. This same model that I'm talking about, we do that with debt consolidation too. So instead of putting 20% down, let's look at putting 10% down and getting rid of these payments. It's astronomical, the difference that it makes in people's lives about what those payments become. And especially if I'm saving them money, driving down then the principal on the loan faster. So
yeah, that's huge. Okay, well, we'll give a couple more seconds here for questions. Otherwise, I'm going to let Russ go. And before you all depart here, I want to make sure I've got a couple of things I need to cover with you. So don't go jumping off the call. We're not quite done. Any questions?
Todd, anytime you want me to come on, let me know, or we can set up.
Thanks, man. I really appreciate you.
Great seeing you.
Always good. I'll be out there in a couple of weeks because I heard a little birdie told me that the tuna fishing is a little crazy right now.
It is insane. I live right in Encinitas, California on the beach, right? So water temp right now is about 74. Literally seeing sea turtles in the water out here, and the tuna are
Wow.
close. So
Can't wait.
I think some of
Cannot
your
wait.
agents are going to get a bunch of bluefin and ahi.
That's exactly what we're hoping for. That's
Hold
exactly
Todd
what we're
to
hoping
it.
for. That's right.
All right, guys.
All right, Russ,
Have a
thank you
good
very
day.
much. Appreciate it.
Talk to you
Everybody
later.
else, please hang tight for just a second. Again, that's Point Mortgage. That's Peter Mendiola's company. Obviously, Peter's been a great friend of ours. And I know we spent a lot of time with those folks over COVID and all of the different masterminds and stuff. Listen, I want to talk to you about one thing, but as I was thinking I was going to go through all of those data points today, and as I was sitting here and I'm kind of like getting my heart set and mindset correct, this thing about plan B kind of kept hitting me. Plan B, plan B, plan B. So I'm not sure who needed to hear this, but I'm going to talk to you a little bit about plan A. And here's what kept hitting me over the head. Some of you are failing to achieve your plan A because you have a plan B. I'm going to say that again. The reason some of you are not achieving your plan A is because of your plan B. And I was reminded, Shannon and I've been married for 17 years. And we didn't have a great marriage for a period of time. And this is not her fault. This is all my fault. Okay. But I will tell you that it's because I had a plan B. And anybody that has been happily married, or any of you that maybe aren't married, that you want to ultimately be married and you want to be married happily, you have to have only a plan B. I mean, you will never, ever, ever do the hard things necessary to have a marriage that stays on track if you have a plan B. You'll never check your ego, which is a huge part of being happily ever married. You're never going to forgive at the level that you need to. You're never going to fight at the level of fairness that you have to have. You're never going to be that person that's going to be there through sickness and health, richer or poorer, if you have a plan B. Because there's always a plan B. If there's a plan B, plan A is, I'm interested, right? I think Tom Ferry says, are you interested or are you committed? Like that to me is what he's talking about. And some of us, some of you, well, I'm not going to lump myself in that, but some of you are doing that in your business. Or maybe other areas of your life. My experience is that if you see it in one place in your business life, fitness, whatever, right? It's probably going to be someplace else. They're a little bit, they're habit forming, right? I want to give you some other examples, right? As you guys know, I'm super blessed to be all over the country, right? Like I get to talk with agents that are in our organization, outside of our organization, in this country, outside this country. I get to meet and work with companies that are all kinds of different companies, all kinds of different value propositions, you name it, right? I hear about people spending $10,000 to attend webinars that are going to have the secret sauce, or $25,000 in ad spends, or $50,000 in lead buys. And literally there is a company, a small or a large team, small company in Colorado that you all know that spends north of $50,000 a month in leads. And then I see people doing mega open houses and tacos and tequila and knocking on doors and picking up the phone. And the difference is that the latter are plan A and the former are plan B. Listen, I've been saying for months that the companies and the agents that are going to get punished through any kind of a market shift are the ones that are in the middle, right? We talk about that from a full service or a no service perspective. Like there are going to be people that are going to make it just simply by discounting every single cost and doing stuff. Hey, I'll sell your house for $399. And then there are going to be people that are going to make it because they're going to deliver the most exceptional real estate experience on the planet. And it is going to be the full service of all full service. But the folks in the middle are going to get punished because they're going to be charging too much and not providing enough. There are those that have been there, done that. Right? Like they expect the change. We affectionately call, and I lump myself in this, the old dogs, right? We've been in the business long enough. We've been forged in fire, right? The strongest steel is one that's been melted and heated and beat on with a hammer and folded up onto itself over and over and over. Like, we're strong. We expect it. And then there are the newbies. And frankly, they just do what they're told. If we're being honest, right? Shout out to Zach Quinn in Grand Junction. I mean, the kid just went and knocked on doors. It's the ones in the middle that don't make the phone calls. It's the ones that have, a plan B, and they're trying to avoid sort of, the pain, the hard work. They're the ones that don't want to spend money on marketing. You know what I'm talking about, right? Like, I don't want to spend money on marketing, and then they can't figure out why their lead flow is inconsistent. This over the last week or two, we have been honored with a bunch of, it's kind of awards season. And we have had like Inc. magazine fastest growing and Real Trends and blah, blah, blah. Listen, I don't mean to belittle them at all, but those things aren't accidental. We boast some of the highest per person productivity in the country. That's you. That doesn't happen by accident. We talk about the data from an agent that, well, here, I'll give you this. When an agent joins Coldwell Banker Distinctive Properties or Prime Properties, the average 12 months following their joining us, they get a raise of 38%. And yet when those agents that leave us, and we do track that, right? They get a pay cut of 57% on average. That means that there's something going on here. That means that you've got an organization who is certainly leading with their plan A. We are committed. On average, I told you that the PPP, highest in the country. That's straight from Steve Murray at Real Trends. The thing that this company, that the newbies and that the old dogs have in common is that we have no plan B, folks. We are committed. We will do everything it takes to win. And our most recent offering to you all is coaching. Did you know that agents that engaged in coaching get a pay raise on average, right? You determine whether or not you're average or not, on average of 70.1%. That's on average. And I'm looking through the list here, and you all are the wrong group, because I see so many of your names are on the list for coaching, and of course, and you showed up here. So maybe I should be saying, hey, this message maybe is for somebody that maybe this message isn't for you. Maybe you are all the people that have a plan A and don't have a plan B. Maybe somebody in your office or a friend or a coworker or something is that person that hasn't signed up. As of yesterday, of our 300 plus or minus agents, 49 have signed up. And I don't think it would surprise anybody on this call to know that the top performers, the ones that I think a lot of people would go, oh, well, that person doesn't need coaching. They are the ones that sign up for coaching. They're the ones. Listen, folks, the markets shift. It's what the market does, right? Our job is to be the smartest, hardest working. I like the SOBs, because somebody told me it was actually meant son of a broker, but SOBs in the industry. Like, I mean, serving the clients, having conversations with people like Russ, having conversations with title companies and insurance companies, delivering better service, understanding where the pain points are, and build at business on a great foundation that thrives in any market, because folks, we have all kinds of markets. It's the constant, right? I'm reminded of the Three Little Pigs, or the Bible study about where you build your house, on sand or bedrock. It doesn't really matter. There are 3 steps. Number 1, you got to be committed. Burn the bridge. There is no plan B. You have got to determine that you are going to win at this business at all costs. That is a mindset shift. 2, you've got to burn the bridge. Get rid of plan B. Plan A is all you need. If you will do that, you will be willing to do things that you wouldn't have otherwise done as soon as it gets hard. And then number 3, get a coach. Get a damn coach. Folks, I have 3 coaches. Get a coach. Sign up. Carrie can put a link in the chat box here. You can go back to the Sunday email. You can go to your AC or MD. Folks, coaching expires. Your sign up expires today. This is it. And we will be divvying out assignments to our coaches, and our coaches are absolutely amazing. I was talking about this the other day. Like, what would it cost to get, and I was thinking of Gary Shook, right? What would it cost to get the number 1 agent in your market to come and sign and coach you? Like, can you imagine? Number 1, you're probably not going to get it, right? But at this organization, we've made some commitments to each other. One of those is to coach some agents. So, but if you could, what would it cost? I think it's priceless, right? Like, it's very, very, very expensive. And the value that you get from being able to learn from those folks is amazing. And what I find is that the top agents, the top entrepreneurs, the top leaders, coaching is the most valuable, because we know how to pick up a phone. We might already have a list. We know the scripts and what to say. Sometimes it's the smallest little adjustment that has epic change and will determine whether or not you happily thrive through a market shift, or if you survive it. So hopefully that helps. No idea who needed to hear that, but I appreciate you guys hanging with me on that. Love ya. Look forward to seeing ya all soon. Thank you. JC, rock and roll. Yeah. Go tell a friend, I think it would be the message I would leave you with. All right. Go tell a friend. All right. See you guys.